Hi everyone, Larry Berman here, and here's what's on my radar this week. If you remember last week, we were banging our fist on the table how important the Fed meeting was, and in particular, the supplementary leverage ratio. Well, the meeting's come and gone. Powell was pretty much as dovish as he could be, but still the Fed is not doing anything about additional liquidity, and they're not overly bothered by the steepening of the yield curve. So I think the bond vigilantes are going to come and go day by day, week by week. We're seeing tightening from emerging market central banks. We saw it in Turkey, we saw it in Brazil, places where inflation pressures, central banks, much more flexibility there. We're likely to see a weakening US dollar vis-a-vis some of these other places, with the Fed committed to be on hold now through the end of 2023. And again, now not bothered. It looks like there was a wink, wink, nod, nod, because the US banks have basically been dumping treasuries for the last month. And that's been the pressure here, knowing, and with Friday's announcement, that the Fed was not going to extend the supplementary leverage ratio. What they actually did was increase swap lines so that money markets don't get congested. So, 6 of one, half a dozen of the other, I guess. But make no mistake, those bond vigilantes will still stress the markets. On Thursday this week, we saw big tech get hit hard as bond yields pushed higher, and we can expect to see bouts and more of that. But it's not about what's happened, it's about what's coming. And what's coming is probably a big upgrade cycle for earnings when we think about what we're going to see with all the stimulus that has come in January, 900 billion, another 1.9. We're looking at $1.5 billion this year that's going to be spent. So not surprising, GDP numbers are going up. That's likely going to lead companies to start upgrading some earnings this year. And we go from 175 to maybe 180. Now, I think a fair multiple is probably 18 at this point, not 25, right? So you do the math on how you get there, but we're trading at around 23 right now. 20 might be justifiable on 180. That's 3,600 at the end of the year. That's where I think we end up, close to it. But for now, with all the excitement over reopening and getting back to business and everything else, repricing earnings, we probably go up first. And then we've got to fund all that debt, July, August, September, October, etc. In which case the Fed isn't buying more than is being issued, and we have a funding problem, and that causes a yield curve flattening, and etc. So we'll worry about that, but for now, 4,100 on the S&P, maybe with an earnings upgrade cycle as we hit earnings mid-April to mid-May. So think about that as your next trade here on the upside, and how best to play that for your portfolios. So in terms of our bull and bear pick of the week, we don't have a bear pick right now. Not that I'm not bearish on things, I'm bearish on a lot of things. But for the short term, you might want to look at one of the innovator ETFs if you want to still be in the market to play the upside, but they have these downside put protections embedded in the portfolios. I can now do structures like this on the funds that I have with BMO. So a lot of tools, we're going to need a lot. Bonds aren't going to protect us like they used to. It's very important investors understand the new dynamics of how to protect portfolios. For years, I've been telling you, own long bonds, own long bonds, own long bonds. There's still a trade there to be had, but with central banks and the Fed in particular wanting inflation in the next couple years, bonds are not the place to be other than for very short-term periods of trading. Have a great week, everybody. And make sure you follow us on our YouTube channel and tune in Thursdays for the next month and a half, where we started our Berman's Call virtual roadshow again. Sign up at etfcm.com or the investorsguidetothriving.com. Have a great week.